Hi there, I'm an advisor from My Tax Accountant. Today we'll explain how freelancers should invoice subcontracted work and maintain compliant expense records.
If you operate as a subcontractor in the UK, a single line missing from your invoice could mean you are accidentally paying a 20% tax penalty straight out of your own pocket for the materials you bought to do the job. Or consider a train ticket. If you bill a client for travel, misclassifying that basic expense as a disbursement instead of a recharge can trigger an immediate VAT penalty from HMRC. Welcome to My Tax Accountant. In this video, we're going to build a bulletproof invoicing and expense workflow, specifically for subcontracted freelancers and sole traders. To execute this workflow, you need two things: your unique taxpayer reference, or UTR, and if you work in the construction sector, you must be registered for the Construction Industry Scheme. Mastering this exact workflow ensures you get paid the right amount, protects your working capital, and keeps your business compliant with HMRC. Step 1 is your invoice. This document functions as a formal legal record. If you leave off mandatory data, the contractor's accounting department will reject it, and your payment will be delayed. Every invoice must have a unique sequential invoice number. You cannot have any gaps or duplicates in your numbering system. You also need two specific dates: the date you issue the invoice and the exact supply date, which is the day you actually completed the work or delivered the materials. Next, list your full trading name and a physical address for the delivery of legal documents, right alongside your customer's name and address. Finally, look at this digital invoice layout. You must clearly separate your labor and your materials into two distinct line items, as highlighted here. You must do this even if you are not VAT registered. Physically splitting out labor and goods on the page is your first line of defense. It prevents the main contractor from accidentally applying tax to your raw materials in the next phase of the payment process. That next phase, if you operate in construction, involves the Construction Industry Scheme, or CIS. Under CIS, the main contractor must deduct tax directly from your payment and send it to HMRC as an advance on your tax bill. When they verify your status, HMRC tells the contractor which deduction rate to apply: 20% if you are registered, a punitive 30% if unregistered, or 0% with gross payment status. Under the CIS framework, the tax deduction applies exclusively to the labor element of your invoice. Let's look at this breakdown. A £1,400 invoice splits into £1,000 for labor and £400 for materials. Because you itemized, the 20% deduction is calculated exclusively against the £1,000 of labor, extracting £200. The £400 for materials passes through untouched, giving a £1,200 final payout. Once you are paid, secure a formal payment and deduction statement from the contractor. They are legally required to provide this within 14 days of the tax month ending to prove your withheld tax was actually sent to HMRC. Enforcing this exact math stops contractors from guessing, prevents HMRC from taxing your trips to the builder's merchant, and protects your working capital. Your working capital is also heavily dictated by how you process day-to-day allowable business costs. Tracking these expenses reduces your total taxable profit, saving you money at year end. As a sole trader, you have a choice to make. You can claim a flat £1,000 tax-free trading allowance, or you can itemize your actual expenses. You cannot do both. When passing expenses to clients, VAT rules are specific. On the left, a recharged expense, like a train ticket. You consumed the service, so add VAT. On the right, a disbursement, like a company's house fee. Pass the exact cost through with zero VAT. Getting this classification right impacts your business growth. Recharged expenses actually count toward your £90,000 VAT registration threshold. True disbursements do not. Correctly separating these out-of-pocket expenses keeps your turnover calculations precise and shields you from retrospective tax liabilities during an HMRC VAT audit. To survive an audit, you need proof. Statutory retention rules for sole traders dictate financial records must be kept for 5 years following the January 31st deadline. A record from 2024 to 2025 must be preserved until January 2031. Historically, keeping records meant stuffing paper receipts into a shoebox, but making text digital is eliminating manual bookkeeping. Notice the strict boundary in April 2026. Sole traders earning over £50,000 most keep digital records and submit quarterly summaries to HMRC using compatible software. You can prepare for this transition right now. Start using a mobile scanning app to digitize your receipts of ledgers in real time. Building the habit of digitizing your paperwork today future-proofs your business, ensuring a seamless workflow and protecting you against severe non-compliance penalties when the new digital framework activates. Let's review the 4 pillars we've established: formatting a legal invoice, protecting your materials from CIS withholding, properly charging VAT on recharges, and digitizing your records ahead of making tax digital. If you need direct help setting up your accounting software or navigating your CIS compliance, My Tax Accountant is here to assist. You can reach our team using the phone number, email, or website currently on screen. Be sure to subscribe to the My Tax Accountant YouTube channel for more practical guides on navigating UK business tax. Please remember this video is for educational purposes only. Tax legislation is highly complex, so you should always consult directly with an MTA professional regarding your specific circumstances. Proactive financial structuring is your ultimate defense mechanism. Putting these systems in place today ensures you retain your independence, your peace of mind, and your hard-earned profit.